two Dutch banks, ABN AMRO and Rabobank, wrote to their customers and said that if you want your gold back, I'm afraid that you're going to get the cash equivalent, not the gold itself. And that showed how much stress the system had come under as a result of negative interest rates at that stage. If you're working in a bullion bank, you will remember that once the sort of immediate dollar crisis after the Lehman crisis had sort of, just eased a little bit, the gold price started running from about 740 up to 1920. And that was on the back of zero interest rates. And the only thing that stopped it was the prospect, at some stage after that peak, the prospect that interest rates were going to rise again and there will be some sort of normality. Don't know when, but it was quite clear that that's the way markets were going to develop. The Lehman crisis was effectively over. The European crisis was coming under control. If you remember Cyprus fell over in that as well.
As a responsible person with growing concerns for your privacy and personal liberty, you want to know where we're headed and what you can do about it. We ask the experts what you need to do to take prudent and responsible action to safeguard your family's wealth and well-being, and what basic first steps will help you to be aware and prepared. ReluctantPreppers.com.
Reluctant Preppers provides educational awareness and commentary only. Opinions expressed do not constitute personalized financial advice. Viewers are encouraged to do their own research and seek qualified personal financial consultation before making investment decisions. Welcome back, Reluctant Preppers. We have Alasdair Macleod, Head of Research at goldmoney.com, back with us again. He's here not only to give us some insights into the Brexit situation in the Eurozone, and also to talk about gold and silver's breakout from a massive base, but also to answer your viewer questions that you submitted. Today is Thursday, August 29th, 2019. Well, Alasdair, thank you for joining us here again on Reluctant Preppers.
That's very much my pleasure, DK.
Before we get into viewers' questions, if you could first give us an update on, maybe we should start with Brexit and Britain's position relative to the Eurozone, and what you see as the latest developments there, and what you think the implications of those developments are in the direction that that's taking.
Yeah. Well, the most recent development has been Boris Johnson has announced that the Parliament will be prorogued, which means it will shut down, in effect, from, I think it's sort of just after next week, and reopen on the 14th of October. The reason for doing this, ostensibly, is to allow the new government to come to provide the Queen's speech, which traditionally opens Parliament, with government policies which are thought out and researched rather than just done on the hoof. Of course, the accusation from the press and from the Remainers is that he's done this to limit the amount of debating time on Brexit. And of course, there is, I think, an element of truth in that. But what he's done is it's really stirred up the anger amongst the Remainers. And they really are making absolute fools of themselves in the process, which is fascinating because I think, in a sense, it's been the deliberate policy, if you like, of jointly thought up between Dominic Cummings, who's the chief special advisor to Boris Johnson, and Boris Johnson himself. So that's the most recent development. Last week he had the G7, and before that he saw Angela Merkel and Macron, and told them the backstop's got to go. And I think his strategy on this is get rid of the backstop. That's the first thing, which is basically the Northern Irish situation. It's all about, do we put in a customs border between Northern Ireland and Southern Ireland, and it becomes a question of sovereignty and all this sort of stuff. So that, I think, he's dealing with that. He said, look, absolutely no way. We're not putting up a border. If you want to put up a border, then you'll get the blame for it. It's as simple as that. And so that's how he has left it. I think when it comes to negotiating the trade agreement, there will be some progress, if you like, ahead of October the 31st when we come out. But I think that's merely laying the ground for further negotiations. In my view, his strategy will be to agree with the EU, and that's actually, I think, what the current talks are about, agree with the EU to invoke GATT's Article 24, which allows people two parties with a current trade agreement to renegotiate a new trade agreement with the existing agreement in place until the new one is properly negotiated. And I think that is likely to be the strategy. You will get lots and lots of noise coming out of Remainers who are screaming like stuck pigs. I think it is actually politically fascinating because the strategy thought out by Dominic Cummings, who you can think of as a sort of Svengali-like type, if you like, is basically to allow the Remainers enough rope to basically hang themselves, and that's what's happening. Things can go wrong. Don't get me wrong on this. Things can go wrong, but basically, it's quite clear what the strategy is, and the strategy is very likely to succeed. So that's the update on Brexit. The problem from the EU's point of view, they've really got to fall in with it because the loss of jobs in Germany, France, and I suppose Ireland as well, is likely to be a material political factor in those individual countries. And furthermore, I think as far as Brussels is concerned, they rather want to push this Brexit thing to one side. They've got enough problems mounting in Italy, if you like, and they need to refocus on dealing with that. The last thing they want to do is to have Brexit and Italy at the same time. So, to my mind, everything points to, shunting the whole thing to one side. There will be no sort of implementation, well, not a formal implementation period. You'll get the GATT 24 article, and the Irish situation is going to just be de-emphasized. It's not going to be a problem. So that's roughly where we are with Brexit. Hopefully, we will get through it without too many other upsets.
That's a very helpful update, and all along you've been telling us that you don't think from an economic or financial standpoint that the outcome will be the end of the world of an actual Brexit should it occur, but that life will go on. So we'll keep an eye on that with your help as well. If you could turn our attention now to the gold and silver market and their recent breakout from a 6-year trading range for gold in particular, but also renewed vigor now, follow through in silver that we hadn't seen originally when gold started to move a few months ago. Could you talk to us about what you think are some of the major factors that are driving this change of behavior of the gold and silver markets and where you see that headed?
Well, coincidentally, I've written a piece which will be published later today on, if you go to Gold Money Insights, on just this subject. It is a very interesting situation because, people like you and me have been waiting, if you like, for the evidence to mount up that paper currencies are going down the drain and gold is going up. Some of us have been looking at, sort of technical points on the charts and come up with the view that, it's got to break a certain level, and once it gets above there, then it might go up to another supply level or what, All that is completely irrelevant, as it turns out. What is actually happening is that the system itself is turning round. The system since really the 1980s has worked on the basis that bullion banks will take gold, and what they then do is, having leased gold, say, from a central bank, what they then do is sell the gold into the market, use the proceeds to invest in US treasuries. And in those days, back in the 80s, typically a lease rate for gold was around about 2%. So they were paying 2% on their gold. And this is an annual rate. And they were getting 6% on their US treasury bills. It was absolutely wonderful as far as the bullion banks are concerned. And that is essentially the point at which the London bullion market really took off in terms of its size and its involvement in the global economy. From there, of course, what happened is that the bullion banks then sort of wanted to get gold in so that they could gear up on it. So they offered unallocated accounts to ordinary customers and, sort of trusts and so on and so forth. And so more gold came in that way. But of course, on an unallocated account, the bank gets the gold and you just get a credit in your account. And so there is an unknown amount of unallocated gold liabilities in the bullion bank's balance sheets. So we have a situation where there is a lot of paper gold around in the form of forwards, in the form of futures, in the form of unallocated accounts, and very little gold underlying it. My guess is it's not 100 to 1, which some people have said. I think it's probably somewhere between 10 and 20 to 1. The normal sort of, if you like, fractional reserve gearing. Yeah. So that to my mind is the sort of guide that we would have. But the important thing to understand is that gold as money actually has an interest rate. It has a time preference, just in the way dollars have a time preference. Now, if you look at history, the time preference on gold is around about 2% at the lower end. I mean, it's been down to 1.5% and so on and so forth since the 1980s. But if you look at what happened back in the 19th century when sterling was on a gold standard, then effectively you were looking at the rate at which gold was lent out through sterling, if you like, in the market. So that gave you an idea as to what the interest rate on gold was in those days. And it varied between 2 and 4%. Sometimes it went a bit higher, but basically it was between 2 and 4%. So what that means is that, when we saw in the 1980s that bullion banks were able to take in leased gold as lessees from the central banks who acted as lessors at around about 1.5%, 2%, maybe 2.5%, in order to buy T-bills at 6% plus, then that rate sort of accorded with the experience, if you like, of the 19th century. Now, so the question is, what is the time preference today, or the interest rate on gold today? Now, basically, the way you work it out is you take the LIBOR rate and you take the forward gold rate in the market and you strip out the dollar element of that to get to the lease rate. And the answer is a big fat zero. There is absolutely, I mean, the lease rate in gold is effectively zero if you look at the forward rate and take out LIBOR. Now, that's sort of a problem, but it becomes even more of a problem when you take into account the direction of interest rates. And the direction of interest rates, quite clearly, is down.
Right.
So, we at this point, we forget what LIBOR is. We just look at, they're saying that the interest rate on gold is forced down to zero, if you like, as a result of the Fed's actions on dollar rates and, the money markets looking at gold itself. So what does this mean? It means that a central bank, which is leasing gold into the market in order to earn a few dollars, as it were, now has no incentive to do so. So the leasing is drying up. It really is. And in any event, a lessee, they're going to take in gold. I mean, basically what they're looking at is to take in gold, to use it as collateral, to do an interest rate arbitrage of some sort. Where can they do it? They can't. That has more or less disappeared. So what you're left is, if you like, a system of using gold, gearing it up into paper gold, which suddenly has no purpose. Now, if you then take the story just one step further, and let us assume that the recession actually is going to be a lot deeper than people currently think. Under those circumstances, you're going to get deeper negative interest rates in Europe, in Switzerland, in Denmark, in Sweden, and in Japan.
And Australia, according to John Adams, the economist we've had on from there, yes.
Yeah. Again, it's exactly the same thing. So where does this leave the Fed? The Fed certainly, under these circumstances, is going to be driving rates down to zero, which basically means that if you've got anything on the LIBOR rate, then basically you're making it even less attractive for somebody to lease gold into the market. So the liquidity, if you like, within the system is rapidly disappearing. If, let's say, this gets really silly and the dollar has negative interest rates, the Fed brings in negative interest rates, then basically the effect will be to drive the whole of the commodity complex into backwardation, because everything is priced in dollars. If you're going to put everything into backwardation, then basically what you're saying is you've got to turn things round. It's not a question of derivatives based on the copper price, the nickel price, the gold price, the silver price, the price of wheat, whatever. It's no longer that at all. The derivative market actually should turn right round and be a small base of dollars on which you expand the derivatives to buy gold, copper, silver, whatever. So what we're talking about is a situation where, with negative interest rates, there is a tax on your bank deposits. You're going to escape from that, not into other currencies where you've got another tax on your deposit. You're going to escape into commodities, and particularly gold and silver.
Because there's nowhere else to hide.
There's nowhere else to go. So we have this situation where the negative interest rates are basically reversing all that expansion that we saw in derivatives from the Big Bang in London in 1985 onwards. So this is a fascinating situation. I don't know to what extent the Fed actually realizes this is a problem. They don't actually understand what interest rates are about. Interest rates basically reflect the time preference of money. It is not a cost of borrowing, if you like, which is, some people will regard it as a cost of borrowing. I can understand that totally. But technically, it is not that at all. It is a reflection of time preference. And if you're going to take in negative interest rates, you are in effect saying that you and I as individuals don't want to possess anything. We would rather possess it tomorrow. That's completely the wrong way around. We place a greater value on something we own. And if someone wants to borrow it, then we expect some sort of recompense, whether it's in friendship or hard money or whatever. I mean, the idea that interest rates are the cost of money is fundamentally incorrect. Yet that is what the Fed and all the other central banks actually believe. So we are seeing something where there's going to be a huge, great clash between the, if you like, the macroeconomic myth about what interest rates are and the reality. That is coming up, and it's going to lead to the complete collapse, if you like, of the derivative markets, particularly in the sphere of commodities. The derivative markets, particularly in the sphere of commodities. So that is reversing. Now, if you can reverse that without there being an unhappy accident somewhere along the way, then good luck to you. But I think it becomes a very risky thing. It's interesting because that is clearly the background to what's happening in gold. It's not gold bugs like you and me. It's not sort of chartists drawing their charts and using Fibonacci numbers, whatever. It's not the speculating hedge funds on, in America buying contracts on the COMEX. No, it's bigger. It's far, far bigger. That's the important point. And I've got all this in this article, which your listeners might like to pick up on our website.
Oh, this is fascinating.
Later on this afternoon.
That's excellent, and it opens our eyes to the dynamics of what's happening behind the scenes. And you had me going on the last part where you were talking about the collapse of the derivative market. I noticed you didn't use the word unwind, which could describe a healthy return to a less distorted or less amplified state. But you talked about the risks that are inherent in sort of all that cash fleeing that market for a safer haven. Interesting.
We would obviously rather have an orderly unwinding, but I dream on is all I can say.
Wow. This has been fascinating. We'd like to turn our attention, if we can, to viewers' questions that have been submitted ahead of you, this interview for you. We never have a shortage of those, so we'll only have to pick a few of those. The first one comes from The Prepared Mind. It's related to something we've talked about in the past, and you may have touched on it briefly just now. Since Alasdair's release of information on the, quote, whale in the silver market, we have seen explosive gains and likely massive responses to suppress. Has any new information come to light about this buyer or buyers, and what can we expect from here on out based on his observations?
Well, the short answer is no. I haven't seen anything else. I think, to be fair, my timing on the article was fortuitous. I wouldn't say that silver price has risen because of one article. Silver is very undervalued. I mean, it's got left behind. It is only now, in terms of price this year, begun to catch up with gold. But you've still got a gold-silver ratio of over 80. I would expect that quite reasonably to go down to somewhere around about 50. But what's happening now, I think we've had the sort of initial run in gold. I have no doubt that gold is still the big driver because of the reasons that we have just been discussing. Silver is in there as well, obviously, because there is a smaller derivative market in silver, but it is there nonetheless. There is also a bit more silver bullion around, so there's a bit more of a float, so the effect could be or should be a little less dramatic. But having said that, the traditional price relationship between gold and silver is if gold goes up at sort of 1%, silver goes up nearly 2%. That's beginning to happen now. We've got this catch-up going on, and we're getting days when silver's actually having a very, very good run, when gold is just sort of more or less consolidating, holding its ground, maybe just making a little bit of ground. So I still think that silver's got quite a long way to go, and I think that at the end of it there will be a degree of rehabilitation of silver as money. Poor man's money, some people call it. You can call it that if you wish. But it certainly has monetary characteristics. And as the full faith and credit of fiat currencies goes down the tubes, I would expect to see silver really come back.
We've got a question from Gas 1123. We've got a question from GSS 1123 asking, can you please elaborate on the rhodium price reaching record highs? Will gold and silver and platinum follow? No one seems to be talking about this.
Well, I haven't been talking about rhodium either. I have no idea, quite honestly. Perhaps I should, but I'm not going to try and make something up. I mean, rhodium is a very, very special market. I mean, I have looked at it in the past, and I've talked to our dealers, and there's absolutely no rhodium around at all. I mean, this was a few years back, and I didn't want to embarrass them by saying, can we get hold of some investment-grade rhodium? It just wasn't available. So I think that probably is still the background to rhodium.
Rai Low asks, if the stock market crashes, will the metals miners also crash as well? And if they will, would you hold your shares through that or sell them and buy back in?
It's an interesting question, because when you do get a stock market crash, then what tends to happen is that people sell the things where they've still got profits rather than the things which have gone right down the tube. So I would expect a general stock market crash to have a negative effect, certainly initially, on mining shares. But having said that, I don't follow mining shares as such. But when I look at the price of gold money, which is profitable. We've just declared a dividend. I mean, for goodness sake, dividend, what's that? I can't remember. We now, so, this is a company with the characteristics which an investor should be interested in. But what happens to the price? Nothing, absolutely nothing. So I think this is very, very early days, actually. The markets are very mispriced, I think. I really don't see that people have a grasp of the economic risks, and because basically what's happened is that you've got a combination of the credit cycle turning, and you've got trade tariffs being increased at the same time. Now, the last time this happened, and I think we've mentioned this before, was 1929, Smoot-Hawley Tariff Act, October 29. That month, when that was passed by Congress, the Dow fell top to bottom 35%. We haven't had anything like that. I just don't see that anybody actually understands the importance, the synergy, the negative synergy of these two things coming together. So as far as investors are concerned, I mean, we're going to have to relive what happened in the 30s. The difference being in those days we had a gold standard, now we've just got fiat currency, so the price effects are different. I wouldn't expect Wall Street necessarily to lose 90-odd%, which it did between 1929, October 29, and the middle of 1932. But I would expect it to come off quite some way. I think if we get negative interest rates in the dollar, then people are going to get, just try and get out of dollar deposits and buy anything, and that will include stocks. And I would have thought particularly mining stocks, because of the point that we were just talking about. If you get this implosion on the derivative markets, then this means that the dollar will go down relative to commodities as a whole, as well as obviously the precious metals. And so from that point of view, I would have thought that there's bound to be a lot of investment, if you like, or flight money going into mining stocks.
Interesting. This is a related question from Helen DLR. Is it possible to see both rising stock market and rising gold and silver prices due to currency devaluation? In other words, both stock market and precious metals are hedging against inflation, so doomsday may not come?
Yes, that is the normal situation in a currency collapse. In order of performance, gold and silver are best. Property is probably second best, and stocks are probably a third best. But you've got to be very selective about the stocks, because quite a lot of stocks collapse in that environment. You need stocks which will still have sales as the currency goes down. You can have a stock with a little bit of debt in it, if you like, so long as it's got the cash flow. That's what it's got to retain.
And
so,
the cash flow that's like recession proof, or that's not going to be hit very particularly hard by an economic setback.
Absolutely, good point. Yeah, no, that's absolutely right. And if you look at Zimbabwe, for example, the Zimbabwe stock market or the Venezuela stock market, I mean, in nominal terms, they've been absolutely fantastic performers. But if you adjust it for the currency, it's not good news at all. So buying stocks in a collapsing currency is not going to protect your wealth. It's just that you will probably lose less, if you like, by owning stocks rather than having all your money on bank deposit.
It's like watching a feel-good movie when a real tragedy is happening. Okay. True Health Now asks a related question. If real estate is in a bubble and metals are starting to fly, does it make any sense to sell real estate and buy the metals?
Well, I don't give investment advice.
That's a good disclaimer, and for us as well.
I must say that.
Talking about a theoretical approach.
Yeah. So all I'm looking at are what is likely to happen to prices. The problem with real estate is that the price of real estate is really set by the level of borrowing. I mean, particularly when it comes to residential property. The reason residential property prices are where they are is because of the ease of finance to pay the prices. Not only the ease of finance, but the cost of maintaining the payments on that finance, if you like. And of course, at the moment, with interest rates zero, and if interest rates go even lower, and they go negative, as they are in Denmark, I mean, you can actually have a mortgage with a negative interest rate in Denmark. Under those circumstances, then you would expect the price of property to hold up pretty well. Because, I mean, as long as the finance is there, then, what's not to like? But there can come a point where, the underlying economy isn't rescued by lower interest rates. And then you have a problem that people can't maintain their payments because they're out of a job. That then becomes very, very serious. And at that stage, property prices would be impacted very negatively. Contrast that with gold and silver. They are underowned at the moment, so that's just an immediate consideration. You've got the systemic changes, which we've just been debating going on. But above all, what you have got is the contrast between sound money and unsound money. Unsound money goes down the tubes. Sound money probably increases its purchasing power at the same time. That certainly has been the history. So looking at property relative to gold and silver, this is why I said earlier, the best performer when it comes to a depreciating paper currency is the precious metals. And, after that, you've got various rankings, whether it's property or stocks or whatever. But, obviously, the worst thing to do is to sit on bank deposits in a fiat currency.
All right. We've got one from Gary E. Worrell, who asks, you have written that China could announce plans to make her currency convertible into gold at a fixed rate. Is that scenario still valid, and when may it likely happen?
It's certainly possible, and interestingly, there have been a few articles recently emanating out of sources close to the People's Bank, suggesting there ought to be a currency reset. Now, the only currency reset that actually makes any sense is one backed by sound money. The idea of, let's say, bringing SDRs forward, that's a pipe dream for a start, because we're not going to be buying things in SDRs, are we, as individuals? And the other problem with SDRs is that all they are basically is 4 paper currencies, which will be inflated to provide the SDRs. So you're not getting out of the paper currency problem. All you're doing is finding another route for governments to print money. So the only thing that will work is a return to sound money. Now, I have no firm evidence of this, but I have circumstantial evidence that tells me that China has a lot of gold bullion in her ownership, which she has not declared and not included as part of her reserves. That does mean that she could quite easily back her currency one way or the other with gold and make it as good as gold. Now, how long it lasts depends how they do it, but it is certainly possible they could do it. The only thing that worries me is that everything that comes out of China is very inflationary. Like they're very ready to expand credit to try and get this part of the economy going or that part of the economy going or whatever. And of course, they control, the state controls the big banks, so they can, more or less print it at will, either as direct money or as credit. What I don't know is whether over the years, they've got so weaned onto inflationism that they actually understand the reason they bought their gold in the first place. I'm not really providing a satisfactory answer, but I really can't. I think that's going to be tested in crisis.
You're giving us perspectives, though, to consider different aspects of this that bring it to light. So thank you. We have one more from Maxim Karakazov, who asks, what does Alasdair think about the pros and cons of investing in rare collectible coins, and how collectibles protect wealth in a crisis situation or a reset compared to bullion metal?
Well, in a crisis, bullion is by far the best, because what you're looking at, as with coins, whether it's coins, art, anything, collectibles, is that they have a premium value, if you like, which depends on people continuing to collect and pay money for it. That can continue when you get a basic sort of non-accelerating rate of inflation in the background. People who have got money go for collectibles because they hold their value. But I think when you get that sort of the real inflation picking up, and on a global basis, incidentally, then under those circumstances, I think pure gold and silver without that premium probably makes more sense. I've always enjoyed the idea of collectibles because there you can give yourself some protection from currency debasement, and you can enjoy the ownership at the same time. But that does depend, if you like, on a degree of economic normality remaining within the system.
Are you saying that the added perceived value that people are willing to assign to something because, as you mentioned, of its intrinsic, or I shouldn't say intrinsic, its historic personal interest is not going to be sustainable necessarily in a crisis situation?
No, because if you're paying, let's say for a coin, let's take a gold coin, if you're paying a 100% premium for the value of that coin, and that is the value in the market over the gold content, mm-hmm. then you're going to be relying on someone else paying a similar premium to take you out at the end of the day, mm-hmm. Or to give you a value for that coin in the future if you're not interested in selling it. And that's fine as long as people are making money and they can afford to, have collectibles and all the rest of it. But when they are not making money and they can't afford to have collectibles, those premiums are not going to be maintained. The moneyness of gold, if you like, will come to the fore, and people will want something, they will want to buy gold, which is very, very close to the market value, rather than pay a huge, great premium for something which has aesthetic value.
All right. I'm going to merge like 4 questions into one here just to get to the nugget of it. There's several that are asking about the relative merits of different jurisdictions for storing gold in a vaulted situation versus holding it in your own private possession. But specifically, there are a lot of questions asking about where would be the safest, the least likely to be seized or confiscated, that sort of thing, as far as holding your precious metals.
Well, yeah, I mean, that is a matter of opinion, really. So I don't want to get into matters of opinion too much, but what I would rather try and do is to just sort of lay down some guidelines. I mean, we have something like 11 vaults, I think, around the world, in a variety of places. I mean, sort of none in America, incidentally, because we've got quite a large American client base. But we've got, Toronto. So you could take the view, if you're an American citizen living not too far from the border, that having gold stored on your behalf, owned by you, not in a bank, as it were, but directly owned by you through an agency such as ourselves, in a Toronto vault, is something that will give you comfort. Because you can go and visit it or take it out, or you feel it's not too far away. There are other jurisdictions which have a very, very strong property ethos. I mean, the reason we set up gold money originally, the original gold money in Jersey, was because James Turk took the view that, having done quite a lot of research, that was one of the strongest property law areas. So the idea that the state can walk in and grab your property is extremely unlikely. I mean, some extraordinary things would have to happen. And even then, it's virtually impossible to imagine that happening. Now, having said that, Jersey is not immune to pressure from the UK. And also they don't have vaulting arrangements, if you like, for gold. But there are other places which do. I mean, Singapore is an interesting one. Hong Kong is or was interesting, but you've got the Chinese involvement there, and I think that would worry quite a lot of American depositors of gold and silver. You have got the Middle East, you've got Switzerland, and the list goes on and on and on. But I think the 2 things I would say. The first is, the ultimate protection is to make sure your gold is stored in a different jurisdiction from the one you live in. That is important. And I think the second thing is make sure that whoever you store it with stores it for you in your name, and it is not, if you like, in a bank account somewhere. The problem with bank accounts is that you put your gold into a bullion bank, and they will just give you a piece of paper saying we owe you gold, or we owe you the equivalent of whatever. But they own the gold then. You want to have something where the relationship is a custody relationship, or what in Canadian law is known as a bailment relationship. So those are the broad guidelines I would really thoroughly recommend. But it is actually very, very difficult to break this property thing. The idea that a government can walk in and take someone's property without their consent, basically means the end, if you like, of any orderly market. So that would be an extremely serious step. In a real crisis, it's certainly possible. And that is why I would suggest own your gold in a different jurisdiction from the one where the government has control over you.
We've certainly got an affinity on a lot of the parts of a lot of our viewers to have some in their personal possession as well, to hedge that even further. Alasdair, our time is short, so if you could give us any final thoughts. You mentioned that this article is going to be coming out at goldmoney.com Insights, and so people should take a look at that. Anything else you want to leave us with before we let you go?
I think that's the important thing. But we are seeing, I really do think, some very, very big changes coming into our lives. The global economy is running into, I think, considerably greater difficulties than are discounted in the market because of that combination, that synergy, that very nasty negative synergy between trade tariffs and the top of the credit cycle. Put those two things together and we do have the potential for what happened between 1929 and 1932. Be prepared.
We've been speaking with Alasdair Macleod, Head of Research at goldmoney.com. Alasdair, as always, thank you very much for joining us here on Reluctant Preppers.
That's my pleasure, DK.
It seems so hard to order. Who can I trust, and how do I even start?
Oh, you just go to sdbullion.com/rp, pick out whatever gold or silver you want, add it to your cart, you can check out, and it's on its way. And they're A+ rated by the Better Business Bureau.
Wow, it's that easy?
Your first ounce of silver is at spot price, and you get free shipping on any order over $99 at sdbullion.com/rp.
After I order gold or silver, how can I trust I'm going to get it? And I don't want everybody to know that I'm ordering gold and silver.
Oh, it's okay. It's fully insured. It's trackable, and you have to sign for it, so nobody else is going to get it but you. And it comes discreetly packaged. If you order a small amount, like maybe gold, it'll probably come in a box that looks something like this. Okay. And if you order a large amount, maybe like silver, it'll come in a box that looks something like this.
Wow.
But it doesn't say gold or silver on there. It might say something industrial or something else like that, but nobody's going to know what you ordered.
Oh, that's great to know.
Your first ounce of silver is at spot price, and you get free shipping on any order over $99 at sdbullion.com/rp.
If I own gold or silver, how will I ever be able to spend it?
Oh, sure. Well, consider good times or bad times. Like in good times, you can sell it back to the same place you bought it from. sdbullion.com/rp will buy it back at the best price guaranteed on the internet. You can take it to a local coin shop and get cash in your hand, completely anonymous. Some people you know may be willing to take gold or silver coins in exchange for goods or services. Now, in bad times, when things have really fallen apart, time after time in history, people have found that in hard times, gold and silver really does come through as something that people recognize as value even after everything else has failed. Your first ounce of silver is at spot price, and you get free shipping on any order over $99 at sdbullion.com/rp.
What if gold or silver drop in price after I order it?
Well, everything fluctuates with time, but nothing is held up longer and better than gold and silver throughout all the changes that have happened in history. Your first ounce of silver is at spot price, and you get free shipping on any order over $99 at sdbullion.com/rp.
What good does gold do me anyway? I can't use it for anything.
Well, I think I found a form you might appreciate.
Wow. That's beautiful. Wow, I can wear that just about anywhere.
And you can take it with you through airport security and across borders. It's small and compact and lightweight, and you can even hand it down through generations. Your first ounce of silver is at spot price, and you get free shipping on any order over $99 at sdbullion.com/RP. Hey, Reluctant Preppers. If you haven't heard, we've already started our monthly 1-ounce U.S. Silver Eagle thank you gift to one active Patreon subscriber each month, signed by your host, Dunnigan Kaiser. And you don't want to miss out on that.
Please help us grow by subscribing today at patreon.com/reluctantpreppers.